Let's talk some movers. Let's talk some stocks. Diane King Hall is in New York. Let's talk some Novo, Diane, because the weight loss biz, boy, it's coming off in a hurry. Yeah. This was a cheat code for investing over the last 2 years. You know, buy anything connected to semaglutide, weight loss, etc. Not anymore, I guess.
No, well, part of it has to do with just how these trials are performing because the expectation was higher. So you're looking at shares of Novo Nordisk under pressure. They did try to spin this positive. This comes off the back of some weight loss trial results. Were there participants in these trials who lost weight? Yes, but not by as much as expected. So you're seeing shares of Novo Nordisk down, the ADR down more than 8% right now. So here's what happened. They said it's next generation weight loss drug. That's CagriSema. It did help obese or overweight patients who have type 2 diabetes lose 15.7% after their weight, but that was after 68 weeks, so it's more than a year. And keep in mind, they had done this other trial. You'll recall this was the trial results were published at the end of last year, where they show that this treatment, CagriSema, helped patients lose weight, lose about a little more than 22% of their weight. At the time, shares of Novo Nordisk were punished then because the expectation going into that, and they forecast this, and we know how much forecasts matter, was that patients would lose 25% of their weight. Heck, who doesn't want to lose 15 to 25%? But because the forecast was 25%, they're getting punished off the back of these results. And Novo Nordisk, again, has been under some pressure already this year following some of the news around these drugs. And, you know, it just hasn't played out so far year to date. And this takes it now lower for the year. Eli Lilly had initially popped on the news. Let me do a quick check of where Eli Lilly is now. Under some pressure, despite the news potentially boding better for Eli Lilly. And I mean, that again may just have to do with some of the overall pressure that we're seeing in the market.
Yeah, they haven't been good for a while. They have been pretty stale now for months. Even Eli Lilly, after making that big push last couple months, stalled out and pulled back in the last week, got hit alongside everything else. So kind of frustrating for those who are looking for that to be unattached from the rest of the market. One that's getting hit this morning, Rocket code down on this deal to get Redfin. I mean, this is really interesting. Good for Redfin hopefuls who have stuck by that chart for the last 9 months.
Yeah, it is. I mean, look, but we often see this with an acquisition, that the acquirer faces some pressure on the news of an acquisition. So this is some deal news in essentially the real estate space. So Rocket Company's making a move. It says it has inked a deal to acquire Redfin. The deal is an all-stock deal at $12.50 a share. That essentially is about just shy of $1.8 billion when you do the calculation. Now, keep in mind, shares of Rocket Company rose about 40% before this transaction went through, this transaction is on the table. So you're seeing shares of Rocket Company down nearly 11%. But again, that's kind of typical with what we see with an acquirer. Shares of Redfin rallying 74%. We often see that, obviously, with the target rallying, because that's clearly playing catch up to the share price, the value of the transaction. So, you know, we may see that run a little bit more because now Redfin is essentially a deal stock, and we just wait for this deal to close.
Yeah. All right. That sounds fair. Right now, the market seems to have pretty much made up its mind. It's made its move, and we'll see how it complements, Rocket. It's a pretty interesting deal. It does seem like the space was kind of looking for something, kind of too much overlap, a little too much competition, not enough going on with housing to, I think, maybe justify how many websites and how many applications there were. Diane, the other thing this morning, want to hit because the whole group is getting really punished in the last couple weeks after a great run. Second half of last year, the airlines are down. The Jets ETF this morning is down 3.4%. That's a big sell-off for this group.
Yeah. It is. I mean, you're seeing a downdraft across the board, across the airlines, and we saw this pattern recently. A lot of this has to do with the uncertainty around tariffs. Bernstein lowering its price target across the group. It doesn't mean they're not constructive on, say, the legacy airlines. So Bernstein has lowered its price target on United Airlines. We know that was an outperformer last year. It's lowered its price target on Delta Airlines. That was a strong performer as well. It's lowered its price target on American Airlines and Southwest. Let me give you the levels. United Airlines reduced its price target to $110 a share. That's down from $115. It is still keeping an outperform rating. But Ali, to your point, before today, United was down 13%. American Airlines, Bernstein's lowered its price target to $17 a share from $23. It is keeping an outperform rating on American Airlines. And keep in mind, it became constructive on American later than it did United and Delta. And we know that last year, American essentially was a catch-up trade because it had made some, changes that didn't work out. So it pivoted on those, and you started seeing airline analysts become more constructive on American towards the end of last year. And the thing that Bernstein points out is just all the uncertainty around this, and just that fear is putting pressure on these stocks. As far as Southwest, it has lowered its price target on Southwest to 31 from 34 for Southwest. They are keeping a market perform rating. And really quickly, I didn't say the price target for Delta, lowering its price target to 66 from 75. Still outperform on Delta. Year to date, Delta down about 9% before today's move.
It had been a pretty kind of clear trade with a clear narrative, people spending, prioritizing travel over high ticket items. And now maybe that's come under question. And if it does, then if this reflects a message about the consumer, it's a really important one, because we have done everything we can as everyday American consumers to keep our money for travel and make that our luxury. And so if this is a message about that ending, then I think it's, to Mike Purvis's point earlier, of an important statement about the consumer.
It is. And I mean, we've been, talking about that sentiment data recently. And although that is soft data, it can be used as a predictive tool. Obviously, you take that in connection with the hard data that we get, especially, for instance, CPI, to see kind of the direction of consumer spending. And we know consumers have really kind of propped up this sector, travel, as you mentioned, whether we're talking about airlines or even some of the cruise lines. They have continued to, kind of put out spending for that. We know that consumers are the backbone of the economy. I mean, they make up about 70% of the economy. But if their pockets are getting stretched, where are they going to have to pull back? It would likely be in travel.
True. It's the one place where we've generally been kind of extending ourselves. Appreciate it, Diane. Good analysis.
All right.
Thanks. Host of Morning Movers. Nice work.